Hello friends, welcome to the Weekend Investing Daily Bite of 8th of January. Not a particularly good day, but the markets recovered from their intraday fall. Intraday basis, markets were looking like the bottom has fallen off, but spectacularly in the second half of the session, markets recovered and traders had a sigh of relief. We are not yet out of the woods, but it does seem like that market is witnessing bouts of buying every time it starts to dip. So from that point of view, buying is still coming in at every level, and maybe very soon we may see some sort of a short-term bottom is the expectation going forward. The topic for today is on death cross threat for the markets. Death cross is a technical uh, formation in the charts. We'll talk more about this in the second half of the video. Do read the disclaimer fully, and please subscribe to the channel if you haven't so far. So the markets, as you can see on this last bar, dipped, took support somewhere near the previous lows and recovered back to close almost flat for the day, minus 0.08%. So there is no sort of move that was happening here that it just the bottom was falling off the market. That has not happened today, at least not today. But again, going forward, depending upon how things will mature in terms of three things this month. One is corporate results. Two is, of course, US presidential speak. And three is the budget. In the next 1 month, all three will come out, and the GDP numbers have already been discounted. So my sense is that 2 days back, when we had the harsh fall, that was probably the market's reaction to the coming numbers, as market always is able to sense what is coming through leakages. Things do percolate to the market, and that has sort of been fully absorbed in the market today. So for markets not to have fallen on a day where the previous day had announced a major GDP number, which was unexpected, shows you that the Bhava Bhagwan is working very well in the markets. Nifty Next 50, however, was a steeper fall, minus 0.8%. It did not stay near the previous day's close, but it did sort of test the previous low and come back a bit, but it still looks quite weak in terms of the chart, 0.8% down here. Nifty mid cap also losing 1% here, some recovery, and this gap is not yet filled. So I would expect that there is a potential further down move here. And small caps also losing 1.38% for the day. Here again, the field is open for it to drop if it has to. Only above these 2 days high will we start to get some confidence on the higher side. Bank Nifty, very, very crucial support at near 50,000. It broke intraday but came back up and closed above it. So for the day, the Bank Nifty has miraculously saved a very major level. I think once that level breaks down convincingly, you'll see a few thousand points go. And that probably has not happened today, at least. 0.73% down on Bank Nifty. Momentum trends, markets mostly red, 367 declines to 127 gains in the top 500 stocks. Heat map, Reliance, sort of the ringleader ahead for the bulls today. ONGC also up. Crude oil has been pushing up now. ITC doing well after the badgering last few sessions. TCS did very well, nearly 2%. But there was no let up in ICICI Bank, HDFC Bank, State Bank of India, and other stocks like Bajaj Auto, Ultrasemco, Trent, and Mahindra and Mahindra. L&T and Sun Pharma also losing ground there. Asian Paints slight gain at 1.82%. The Nifty Next 50 landscape was even more red. So United Spirits, JSW, Siemens, HAL, Zomato, Divi's Lab, Indigo, REC, PFC, all losing ground. Only Bajaj holding, Gas Authority and LTIM managing some small gains along with Lodha and Bank of Baroda. In the sectoral trends, pharma losing the most today, minus 0.9%. PSU banks losing 0.8%. Bank Nifty overall losing 0.7%. Metals also losing 0.7%. Private banks losing 0.5%. Private banks are the first sector to have gone into red for the last 12 months. That tells you, how flat private banks have been in the last 12 months. Autos losing 0.5% today, and the others some meaningless 0.2 to 3% down. FMCG surprisingly did not fall today. Usually the weakest parts of the markets fall the most. So this is uh, maybe you can say some hope uh, out there that FMCG probably is bottoming out. Despite a good fall in the market, FMCG stocks did not fall, actually up to 0.4%, or there was a rotation towards FMCG and IT, where IT also went up 0.6%. So FMCG also for the 12 months gone by is up only 0.5%. So now you know why sector rotation is important in your portfolio, so that you keep up with the stronger sectors and the stronger stocks in the markets. Oil and gas up 1.5%. So oil and gas is the only sector which really has bucked the trend the last two sessions. Oil India, ONGC, Castrol, GAIL all up more than 2%. Reliance, BPCL and HPCL also giving them support. Within the portfolio momentum score report, the one which gives you the momentum score, if you upload or enter your stocks in the momentum report on the weekend investing site, it can also give you the weighted skew, and we choose some low momentum score to show you how poorly some stocks perform over time and how momentum will keep your portfolio clean of all these stocks at all times. So IndusInd Bank has a momentum score of 1.3 out of 100 in our study, and essentially none of our portfolios would have bothered about IndusInd Bank all year round. So this is how you protect yourself from extremely weak stocks. In the last 12 months, IndusInd Bank is down 40%, while the Nifty mid cap is up 23%. So staying with the strength remains the mantra for weekend investing momentum strategies. Death cross. Some of you may already know it, some of you may be new to this. So let's go for the definition. What is the death cross? Death cross is nothing but a theoretical calculation of the 200-day moving average and the 50-day moving average moving crossing each other. So you can see here, this is an example of S&P 500 chart. This is the 200-day moving average. This is the 50-day moving average. And whenever 50-day moving average will cross the 200-day moving average from the top, it will be called a death cross. Why? Because the 50-day moving average is a shorter moving average. Whenever it dips and goes below the longer moving average, which is the 200-day moving average, it is a higher probability that the markets are likely to move further down. There is no concept of certainty, but there is certainly a concept of probability that is associated with any moving average combination. So for instance, Nifty 50 right now, the 200-day moving average is at 23,923. The 50-day moving average is at 24,088. So it is very, very close. Maybe the Nifty 50 will have a death cross coming forward. The Nifty Junior, on the other hand, has already seen the death cross, and while the exact day or the level may not be so important for a death cross, but what happens usually is that a lot of algorithms, traders, and rules based on death cross may be existing in the market. So a lot of traders may have this rule that whenever 50-day moving average will break the 200-day moving average, we will sell out our portfolio. So that is the sort of you can say a psychological grouping of liquidities of sell side that comes through on such occasions. Otherwise, by themselves, neither 200 DMA has any importance nor 50 DMA has any importance. But because more and more people watch these specific averages and their relationship with each other, that is what creates some of that lumped selling pressures in the market. So in Nifty Junior, in the last 2-3 sessions, there has been a dramatic selling pressure, and it may be due to this death cross having got triggered on this. Now, in the past occurrences of death cross, we see more recently in COVID times, the death cross happened here, post which the market did go down somewhat more, but then recovered back also. In April 22, again, you had a death cross here, and the market took a few months to 3-4 months to come back up, and again, this shorter moving average was above the moving average. In June 2015, again, somewhere here, you had the death cross, and it continued for almost 1 year before the shorter moving average moved up, and then there was a sort of a, you can say, a fake trade that happened here as well. Then in March 2008, if we go back after the huge run up that you had from 2003 to 2008, where you can see the short term moving average never came below the longer term one. So death cross happened here. The market did go above, but the moving average continued to go down, and the death cross uh, correctly showed that the market was going to fall right there. September 1996, again you can see a death cross move here, which gave you a nice down move here, as well as the one move here, which gave you a move here. So the idea here is that it is only a probability, it is only cautioning you for an event to happen, and there is no certainty. So like for instance here in 2013, it quickly came back up, and this trade, if you had sold here, you would have had to buy somewhere here, so you would have lost money on that. Similarly here, very short term dip that happened in 2016, and some confusing signals. If the market goes into a sideways mode, then obviously all these indicators, which are more trend based indicators, will give you confusing signals, because the markets will chop around the same level. So what has also happened over the last 30 years is that the volatility in the market has shrunk. So the distance between the 50 and the 200 DMA, which used to be significant earlier, from 2010-11 onwards, that has shrunk quite a bit, and the movements have become limited. So which pockets are relatively stronger and weaker? So if we see the different indices, so within the Nifty 50, 12 stocks have already had the death cross downward. Nifty 50 has 54% of stocks which are in currently in death cross. So you can see that Nifty 50 is the worst hit uh, pocket right now, uh, versus Nifty, where only 24% stocks are in death cross. Mid caps are at 33%, and small caps are at 34%. So here also almost a third of the stocks are below the death cross point, or death cross has happened. So this tells you, relatively where each index stands, and what is the kind of pain that is there in each of the index. And within the sectors, you can see, like in pharma, of the 20 stocks, only 10% stocks are in death cross. So pharma is reasonably strong. IT, no stock is in death cross, very, very strong. But FMCG, you can see 33% stocks are in death cross, and autos are somewhere in the middle at around 20% of that. So here again, you can see some comparative, studies that can be done on where your money should be going. So should you be worried? I think not. This is only a probability and not an absolute certainty. So whenever Nifty does have a death cross, maybe you could wait for some time before trends start to move up. If you were going to follow some particular moving average, or if you're going to put in money and you want the trend to be in your favor before you put in your money, you could look for that. It could identify ways of strength among sectors or among indices for you, so it could be used as a tool. And very surely and always, it should help you to get rid of laggards. So any stock which you hold where the death cross has happened, in my view, maybe there is value in that stock now because of the fall, but from a trend momentum perspective, you should not be in that stock, because that can really lead to a lot of downside without you having any potential stop, etc. on that. So the question here is whether we will witness a death cross in Nifty 50 soon, is the one that you can answer in the comments, and let us know how you like this content. Thank you so much for watching. Do like and share these videos. We really need your subscription on this channel, and do share it with your friends and family. Thank you. Bye bye.